Howdy folks, it's Jeff Camarda again. Thanks so much for watching on why the stock market appears to be so buoyant from a recent Wall Street Journal article. Why are markets so calm? It's the revenge of the quant funds. And the basic thesis is program trading, which is what they used to call computer programs making decisions. Now you probably would prefer AI, but it's basically machine decisions according to trading rules. And there are funds that look for low volatility, low change. Does it go up that much? Does it go down that much? Does it go up that? As a sign that the market is investable, and the lower the volatility, funds like this, the more money they put into stocks, which may explain why we seem to be at such elevated levels. And as you know, for some time, I have felt that market values are stretched and fall may be in the offing. But on the other hand, it doesn't matter what I think, and this is important to remember. We make decisions based on what the indicators tell us. Even if we think things are overvalued, if things are going up, we want to have a piece of it, but we watch it carefully to watch the indicators to hopefully get out before things reverse too terribly. So quoting from the journal here, despite the political uncertainty, the rebounding stock market has barely gotten nicked. Over recent months, stocks have handily overcome stress in the banking system, stubborn inflation, and interest rate hikes. The market's steady rise has puzzled analysts and portfolio managers. One explanation may be quant funds, or those relying on computer models and automated trading, have been doubling down on stock markets as other investors have stepped back, citing high valuations, concerned about other investors like me, high valuations, and concerns about the likely course of the U.S. economy. Those clouds remain. Quant fund buying has pushed these funds' net exposure to U.S. stocks to the highest level since December of 2021. The market has started to see early signs of eroding tranquility, however. Last week, the volatility index, the VIX, the fear gauge, on Wednesday briefly settled above 20 for the first time in about 3 weeks. Typically, anything higher than 20 indicates fear is on the rise. For now, though, the continuing demand from these quant funds, these program tradings, has provided a lifeline for the stock market. The buying has helped counteract selling pressure and has led to placid moves. For the S&P 500, for instance, has moved less than 1% in either direction for 36 of the last 46 sessions. Quoting Deutsche Bank, we've seen them sort of balance each other out for the last 6 or 7 weeks. Driving the quant funds is a self-reinforcing dynamic. When market volatility drops, they pile in more. Big stock market moves subsided this spring and remain relatively placid. So so-called volatility control and risk parity funds, which tend to automatically load up on riskier assets during calmer periods, ramped up equity exposure, driving markets higher. The dominance of quants has helped explain previous periods of calm trading, including long stretches in 2017 and 18. Those periods were punctured eventually by rapid sell-offs, including the 2018 sell-off dubbed Volmageddon for volatility, when dynamics exerting calm on the market suddenly went away. Some warn a repeat could be ahead. I am among them. However, as old-time technical analysts are wont to say, the trend is the trend until it changes, and we certainly seek to participate in uptrends and manage appropriate portfolios in such a regard until things change. And until the next time, thank you once again for watching. Bye-bye.